How's it going, everyone? My name is Derek Afasi, and today's topic I want to discuss with you what is a fixed indexed annuity, what are some of the pros and cons of this sort of financial product, and how someone could kind of use it for retirement planning, retirement income planning, either now or at a later date, and kind of defer it out in future years. A very simplistic understanding on exactly why somebody would want to enter or place money into a fixed index annuity is quite simply to eliminate any of their downward market risk to their retirement accounts. Now, fixed index annuities are something that they're fairly new. When they were first implemented in the early 90s, they had a lot of problems with them. They had a lot of cap rates, and you might have heard a lot of bad press. And I really think that because of some of the bad media attention that is brought about the changes of fixed index annuities, and some carriers and some contracts out there currently are very favorable for an individual situation, especially opposed to compared to other financial products out there. But once again, the most important thing is that it eliminates downward market risk to retirement accounts. Now, how exactly does this do this? Does this work? With a fixed index annuity, someone would roll over their money, whether it's in a lump sum from cash, whether that's from an old 401k account, old IRA account, and rather than keeping that money into mutual funds or a stock or a bond, there's a certain risk there. There's a risk associated with it, and what happens is you have downward market loss, potential downward market loss, downward market risk, and you also have the fees of paying a mutual fund fee, of paying an advisor fee, different things like that. So when you roll over your money into a fixed index annuity, the way that the contract works is it works on a very fixed type realm. So it has the same legal reserve requirements as an immediate annuity, as a fixed annuity, as a hybrid annuity, and essentially meaning that it's very safe type of product. The way that their reserve ratios, the way that the company backs up the contracts is in a very safe manner. Now, the most important thing that you guys probably want to know is, okay, what exactly happens with my money? Why exactly would I want to go into a fixed index annuity? Well, rather than with a fixed annuity, or if you think about, a fixed annuity or bank CD, that's a fixed set rate of return that will be paid to you year by year by year. The problem with that is interest rates are so low right now. Okay, interest rates, they used to work when people were leveraging bank CDs and fixed annuities for retirement income planning. You could essentially throw a lump sum of money into a fixed annuity, and for 5 years, 7 years, 10 years, whatever it is, and just live off the interest and never touch the principal, never dip into the principal. And it'll happen year by year by year. Now, unfortunately, because of the economy, everything that's been happening, our interest rates are so low right now. So you have something known as inflation risk that is hindering retirement accounts. So people say, okay, well, rather than just throwing my money into a fixed account, let me just go into mutual funds and let me just ride it out with the market. Like you hear a lot of advisors that are trying to tell you, oh, place in the market, place in the market. Well, if you're not looking for the risk there, and you want to have a retirement, and you want to essentially leave this money for income at a later date, throwing in the mutual funds and throwing in something that is potentially risky, that's the mistake that I see time and time again that a lot of seniors and a lot of retirees or pre-retirees are making, is because they have that downward market risk. They have that potential downward market loss. So with a fixed index annuity, it works like the same concept of a fixed annuity of paying you a fixed percentage rate year by year, except for that percentage rate that's going to go into your principal, that's going to go into your account, is based upon a stock market index. And it's only on the upward market growth, not the downward market loss. Because every year what's happening is you're risking the interest that would potentially go into your account. You're not risking the principal. And that's very important to understand. With variable annuities, your money, your principal is being invested into a mutual fund, meaning that if the mutual fund goes down, your actual principal and the money that you have invested within these insurance companies will go down. With a fixed index annuity, it's just a computation that's set up that says, okay, did your stock market index that you chose, and typically have 3 or 4 different types of accounts you could choose from, did it go up? If it did go up, then you're going to receive some sort of upward market gain into your account. If that market dropped that next year, you do not see a loss to your principal. So you're only seeing gains. You're not seeing actually any losses to your accounts. And it's very, very favorable for the consistent growth, the consistent safe market growth that individuals want to see with their retirement accounts. And they don't want to check, MSNBC every 5 seconds saying, oh my gosh, what's happening to my money? So this is a great alternative. Essentially what's happening is you're placing your money into, whether that's in a cash account, an old 401k account, old IRA account, you're placing it into a fixed index annuity contract, and your account value is either going up with the market or staying exactly the same, going up with the market or staying exactly the same. Where these contracts get pretty attractive is it provides a constant income during your retirement years without the worry of outliving your money. Now, there's something known as a hybrid annuity, and a lot of advisors are not, surprisingly, a lot of advisors are not accustomed to these new types of annuity products. They came out after 2008, and essentially what it has is the basis of it is a fixed index annuity, so your account value is staying preserved. It's either going up or flatlining, going up or flatlining, but you have a secondary type account in there known as an income account. So the income account kind of works like a personal pension plan. So rather than just play the guessing game during retirement, you could place your money into a fixed index annuity, whether you're going to retire within 30 days or 6 months or even 10 years out. There's a certain plan that allows to have deferred growth, and then when you're ready to turn on that income stream, it'll be income that you could never outlive. So an individual might say, okay, well, why don't I just leave my money in a cash account and I'll just kind of pull it out slowly year by year? Well, there is something known as a 4% rule, and it's set up through a lot of financial advisors have set up this rule, and they say, oh, as long as you leave your money either in a cash account, you leave your money in mutual funds, you should safely be able to take out 4% year by year by year. Well, some of these contractual agreements with the hybrid annuities, which are set up through the fixed index annuities, they give you upwards of 6%, 5.5% in those later years of retirement that are contractually guaranteed by the company. So it's just a very big game of leverage at that point of saying, okay, what's the smallest amount of dollars that you could leverage into one of these plans to produce you a set income stream that you can never outlive? So that's the most important thing. And what you do not want is you do not want to place all your money into a fixed index annuity and all your money into a hybrid annuity. You want to place the correct amount in there. And I always make one of these generalizations of everyone's probably seen that commercial which says, oh, what's your number? What's your retirement number? And it's the guy, he's cutting the bushes and he shows his number is like right on the bush. That's not the number that you have to look at for retirement, because that's a lump sum number. Your number that you have to figure out is, how much do I need every single month for my retirement income? Now, understand, you might have a pension income set up, which is very rare these days. Unfortunately, it's very rare because pension plans were excellent financial products. So you might have pension income, you might have income from Social Security coming in, and then you have a certain gap. Could be a couple $1,000s, could be upwards of $5,000, $10,000. So the most important thing is, okay, how can you leverage your lump sum monies, throw them into certain contractually guaranteed products through these insurance carriers, and make sure that you are having that income supplemented precisely to the exact dollar amount, and you're leveraging the smallest amount of dollars possible so that you could leave those lump sum payments and kind of use it as your fund money. And really, if that's leaving it in an IRA, if that's throwing into a cash account, buying an Apple stock, whatever it is, at the end of the day, what we try to do here at Afasi Financial Group is educate you, make sure that you understand exactly what each product is, and realize that you guys have the power during retirement, and you could leverage the companies and not have the companies leverage you. We're an independent financial agency, so we give unbiased recommendations, meaning, if there's a contract better, if there's a carrier that's better for one situation over another, we're going to tell you about it. It's not, we're not a one-size-fits-all type shop. Now, some of the cons, so please, call our 1-800 number on the screen. We're open 24 hours a day, and we just actually implemented that in April of 2014. So please, just to even have a conversation before you're looking on either getting involved with any sort of annuity, give us a call and we'll try to educate you best we can. But I want to drop down to the cons, because there are some cons with fixed index annuities. It's not just all rainbows and butterflies with this type of product. There's limited liquidity with this, and it makes a lot of sense because you can't necessarily always have your cake and eat it too. The company is going to, and what we do is we try to dissect the best possible carriers and the best possible contracts, and there's hundreds and hundreds of these types of contracts out there, and we want to make sure that you're getting the best bang for your buck, essentially. But there's a caveat to it. There's going to be limited liquidity, and what I mean by that is if you place X amount of money into these contracts, this is supposed to be geared as a long-term contract, meaning that you're going to have to keep your money within 10 years. You have certain surrender charges, within 10 years of if you place your money in, and 2 years later you say, oh my God, I hate this, I want to get out. Well, there's certain guidelines, there's certain limited liquidity there. So you want to make sure that you're very educated on exactly how this process works. Some companies are more favorable than others, that you could actually take money out completely penalty free. But as long as you're playing by the rules of this contract, and I always stress, if you set up the contract exactly how it's designed, this could be an absolutely fantastic product. If there's certain gains where you're saying, oh, I want to place money in, pull money out, place money, then you should not be placed within a fixed index annuity. And I want to make that very clear, so that it could further your education when you're looking up some of this information. Understand what the cons are, and also cap rates. You have some companies that came out, they have uncapped type index rates, where you might have something tied to an S&P 500, you might have something tied to a Dow Jones Industrial average. So it all kind of depends upon the carrier, and understand that there is not a one-size-fits-all type product. If you're age 62, there's going to be a better carrier, better product for you. If you're age 72, there's going to be a better carrier, better product for you. So just understand that there's no generalization when it comes to these types of annuities, and you want to make sure that you're dealing with a specialist, that you understand exactly, or the company that you're dealing with understands how to get the max amount of income in your pocket at the end of the day, and how you could leverage the insurance company or these types of fixed index annuity contracts and not have the insurance company leverage you. Very, very important. So once again, my name is Derek Afasi. I'm this cool-looking cartoon guy right over there. Please call the 1-800 number on the screen, and you'll either be dealing with one of my specialists or myself. 1-800-566-1002. Thank you very much for watching this video, and please be on the lookout for some of my other videos. Thanks, guys.